Good evening, everybody. I hope you had a very fruitful discussion on GSTR 9. Among these two topics, GSTR 9 and 9C, I can say GSTR 9 is the most complicated one because of various adjustments which are there in the returns. Then you have a new advisory also which has been released yesterday. So because of this, there are many confusions which are there. Whereas if you see GSTR 9C, it is not so much complicated, because there are few complicated tables which have been made optional as of now. Once they make all the tables of GSTR 9C mandatory, then even 9C is also going to be a tougher exercise for all of us. So what we'll do is we'll understand some basics before getting into GSTR 9C form. The provisions related to GSTR 9C. We'll understand the format, some issues which are there in the format. Then what are the additional things which we should consider when we are doing GSTR 9C? Most of us, what is happening is we will do this GSTR 9C as just fill in the blanks exercise. So it should not be limited to that. I can see that most of your consultants are from Chartered Accountants Office. If you have to add value to our clients, we need to make sure that we go beyond this form to add value to our clients. So adding value to our clients need not be in identifying missing out on the credits or some benefits. It can be in form of identifying even the liabilities which they are supposed to discharge but not discharged by the taxpayer, because you are going to save the interest as well as penalty in that case. So that is also a kind of value addition. The first thing which we need to understand is why we need GSTR 9C. Because we did not have any audit or annual return concept in service tax or central excise, though we had that in sales tax, which again got carried forward to VAT regime as well. In VAT, most of the states had this concept, which is very similar to what we have in GSTR 9C. So there was a requirement to match your sales tax figures with your financial statements. If there are any differences, then the reasons had to be provided. So the similar concept has been copied in GST law as well, because all of us know that GST is a mixture of service tax law, central excise and VAT law, and some concepts of European VAT law has also been brought into the present GST law. The first question for which we need to find answer is why we have GSTR 9C format when there are monthly returns. And monthly returns also, we have so many forms. For outward, there is a separate form. Then there is a summary form, which is called GSTR 3B. Now we have something called GSTR 1A. There are so many things which are coming out with. Then we have IMS system. So when there is a full control on the data of the taxpayer, why we still have GSTR 9 or GSTR 9C is the question. The answer to that is GST is a self-assessed tax. When we say self-assessed tax, in GST, the department will not come and tell you for each and every transaction what is that tax which you need to pay, and they will not check whether you are paying this tax or not. Whereas earlier, for example, if you go back to central excise regime, the central excise officer used to sit outside the factories. Any goods moving out after manufacturing, the taxpayer had to pay the excise duty. Only when that proof is showed, then the officer used to allow removal of goods outside the factory. Then slowly there is an evaluation. Now we have a concept of self-assessment of tax, which came in central excise, then it came into service tax, it was there in VAT also. However, the department needs some control, because everything is left to taxpayer, then there can be a misuse of this provision also. So there has to be some checks and balances. For that reason, there was a concept of audit certification by the chartered accountant or the cost accountant. But for some reasons, because it was shown to the finance minister or the GST council that there is no value addition which is being done by the persons who are doing the certification. It could be chartered accountants or the cost accountant, because what was happening is they compared the tax revenue which was generated through GSTR 9, that is annual return, versus GSTR 9C. So GSTR 9, the certification was not required by chartered accountant or the cost accountant, whereas 9C required the certification. So what used to happen is, most of you would have done this 9C when certification was also there. We used to support the clients in filing both GSTR 9 and GSTR 9C. If there was any liability, we used to make the taxpayer pay that additional liability through GSTR 9 itself. Through GSTR 9C, there was very less amount which used to get paid. So because majority we wanted to cover in GSTR 9 so that we don't have to do any qualification or observation in GSTR 9C. That was the whole intention with which this practice was followed. But the picture which has been given to the GST Council or the Finance Minister is that the taxpayers themselves are identifying the tax payments and paying through annual return. Through 9C, nothing is happening. Because at that time, the revenue which was there is 3,500 crores through GSTR 9 and around 305 or 310 crores through GSTR 9C. So this wrong picture was given, and for that reason, the audit or the certification requirement was also removed. Now, the biggest impact is, though the compliance cost may have got reduced to the taxpayers, the burden or the responsibility of correct disclosure in GSTR 9 or GSTR 9C is on taxpayer now. When certification was there, if there was any mistake, then the taxpayer could have said that it is this so-and-so auditor who has done the certification and he has done the mistake. But now this advantage will not be there because it is going to be a self-certified form now, GSTR 9 or GSTR 9C. So that is one disadvantage. What else? So GSTR 9, we know that GSTR 9, we can correct the information if you have done any mistakes with respect to liability or credit disclosure, we can make those corrections in GSTR 9. That is still possible. However, GSTR 9C, it is more of reconciliation between your financial statements and GST returns, which is not taken care in GSTR 9. So therefore, GSTR 9C is a second opportunity for the taxpayer to make a correction if it is not done in GSTR 9. When the certification was there, there was a lot of importance also which was being given by the high courts also. There are multiple decisions wherein the high courts have held that if the GSTR 9C form was not considered by the department, wherein the auditor will certify on the turnover, ITC, etc., then there used to be a rejection order or the appeal by the department used to get rejected. This is one decision of Calcutta High Court, wherein the High Court held that when GSTR 9C is not considered by the adjudicating authority, then the matter has to be remanded back for reconsideration again. So this was the importance of GSTR 9C when certification was there. Now, since the certification is not there, I don't think this benefit is going to be there from high courts as well. Audit. So many of us still feel that what we are doing by doing this GSTR 9C support is audit, but that is not the case. We need to understand what is the meaning of the term audit. Audit has been defined in GST law like any other tax law. The audit means examination of records or documents which are maintained under any other law for the time being in force. So if you are maintaining any law for the purpose of RBI, if there are any records for the purpose of income tax or any other law, even those information can be verified by the auditor. Now, who is the auditor here? The chartered accountant may not be the auditor going forward. Now, under section 65 of GST Act, when the department conducts the audit, the officers will be considered to be the auditors, wherein they can verify any of these records. Now there is a concept of special audit as well in GST law. Special audit can happen only when department feels that there is some issue with respect to the credits which are being taken, or there are some issues with respect to valuation and credits. In case of these two scenarios, the department can hire chartered accountants or the cost accountant to do a special audit. So in that case also, this definition may of the relevance. Now the records maintained under any other law, so this can be verified only for the purpose of checking the correctness of GST turnover declared, the GST taxes paid, GST refund claims, ITC claimed, or any other compliance with respect to GST law. He cannot just verify your income tax return just to see any other information. Say, for example, he can see the income tax form 15 CB or form 15 CA, whatever it is, wherein we get the information with respect to import of services or the import of goods. In case of import of service, there is an impact with respect to liability under reverse charge mechanism. So in order to make sure that the liability has been discharged, the auditor can always seek this information. But when it comes to GSTR 9C, this is not mandatory, but this is what I was saying in the beginning. Though we do only GSTR 9C filling the respective tables, the assignment should be taken in such a way. So you should also speak to the client. If client is expecting only to do fill in the blanks, we should tell them what are the advantages of doing the compliance review along with GSTR 9C support. We do this support, and in most of the cases we do compliance review also, because without doing compliance review, when we do 9C, then the client may not get actual value because it can be still with lot of errors. Say there is an exemption which is being claimed by the client. If you're not checking whether the notification or the conditions attached to such exemption is fulfilled or not, then it is like giving a wrong information to the department, wherein the penalties can go to higher amounts, which can be up to 100%. Aggregate turnover. So this is also something which is very important, because we have something called aggregate turnover limit, beyond which the 9C or GSTR 9 needs to be filed. For the purpose of 9C, aggregate turnover should be 5 crores. If it is less than 5 crores, then GSTR 9C is not required to be filed. So, but we need to understand what is this aggregate turnover. Aggregate turnover includes the value of your taxable supplies, but we should not include the expenses on which GST is paid under reverse charge mechanism. Say my turnover is 4.5 crores. There is an expense of 70 lakhs on which I have paid GST under reverse charge. It should not be 4.5 plus another 0.7, wherein it crosses 5 crores. We should outward supply needs to be considered. Then if there are exempt supplies, exemption could be by way of notification, or it could be nil rate goods or nil rate services. Even in those cases, the value should be considered for computing the aggregate turnover. Say you are into construction, you have only advances, you are not issued any invoices during the year. Your value of advances is 10 crores. Whether GST 9C is required or not, the answer is yes. You should consider the advance receipts also for the supply, because even that will be considered to be a taxable supplies. Then export of goods and services, even though you don't pay GST on exports, that needs to be considered. Any interstate supplies to your own branches. Say you have a godown in Chennai, manufacturing unit in Bangalore. Even the stock transfer needs to be considered for the purpose of this aggregate turnover, if you are paying GST on that. If you are not paying GST on the stock transfer, then you don't have to consider any value for this purpose. Very important point in this is, this has to be computed on all India basis. You have a turnover of say 4 crore in Karnataka, 2 crores in Tamil Nadu, then the total aggregate turnover in this example is 6 crores. The GSTR 9C form has to be filed for both Karnataka as well as Tamil Nadu. It is not that for each state you will see whether it is crossing 5 crores or not. You have to see pan India. Pan India, if it is crossing 5 crores, then the GSTR 9C required to be filed for all the registered places. Karnataka may be 6 crores, Tamil Nadu may be 0, but you have a registration in Tamil Nadu, then you have to file GSTR 9C for Tamil Nadu as well. One interesting scenario which may come here is what will happen if I have some transactions which are neither considered to be supply of goods or supply of services. For example, I have a land. I am a proprietor. I have say furniture business. My turnover is 4 crore for last year. Last year I have sold a land also. Land value is 10 crores, which is there in my financial statement also. Now, as per the financial statements, the total turnover is 14 crores. Now, the question which comes is whether this GSTR 9C required to be filed or not. If we see Schedule 3 of CGST Act, the heading says activities which are neither to be considered as supply of goods or supply of services. When it is not a supply transaction at all, then my view is that we should not consider that activity for computing the aggregate turnover also. So in this example, the aggregate turnover should be 4 crores and it should not be 14 crores. But if you want to be very conservative, if you don't want to take any chance because this is subject to litigation, then it is suggested to file your GSTR 9C form. Legal provisions, we should understand which law or which section or the rule says that GSTR 9C are required to be filed. Section 44 says that the annual return needs to be filed along with self-certified reconciliation statement. You would have discussed already with Akshay, so I'm not going to discuss much on this. Section 47(2), this is a bit interesting. Paid whenever there is a delay. Now the question which comes is, say I have filed my annual return, but I have not filed my GSTR 9C. I filed my GSTR 9C only on January 31st, but 9 I have filed it on December 31st. So there is no late fee for annual return. What is it which I need to pay for GSTR 9C? Should I pay late fee for GSTR 9C or is there no penalty for that? The answer is there is a general penalty of 50,000. The general penalty is as per section 125, which says up to 50,000 is the penalty amount which can be levied by the department. It is the discretion of the department. The departmental officer can say you pay only 1,000 rupees or he can ask you to pay 50,000. So normally what happens is he will ask you for 50,000 rupees. Now there are notices wherein the demand of late fee also has been made. When 9 is filed but 9C is not filed. This is based on the interpretation that if you see section 44, it says annual return needs to be filed which may include self-certified reconciliation statement. When it is not including self-certified reconciliation statement, then it is as if you have not filed complete annual return. Annual return is not complete because you have not filed your 9C. So based on that interpretation, the late fee is being demanded on 9C also, which can be, of course, can be contested, saying that even if you see the format, it automatically computes this penalty or the late fee only for GSTR 9. Then rule 80 sub rule 3, it talks about who is required to file 9C and what is that turnover limit which needs to be considered. So turnover limit as per rule 80 sub rule 3 is 5 crores. Annual return, we know that it is 2 crores, but for the purpose of annual return, every year there is a notification which is being issued by the CBIC board. If that notification is not issued, then for rupee 1 turnover also GSTR 9 is required to be filed. There are certain records or books of accounts which needs to be maintained mandatorily by all the registered person. This is as per section 35. When certification was there by chartered accountant or the cost accountant, we had to certify that the books of accounts have been maintained appropriately in GST along with GSTR 9C certification. So we had to understand what is the books of accounts which needs to be maintained. So section 35 says every registered person shall maintain certain records at his principal place of business. So what is principal place of business? When you see your registration certificate, you will find one address as principal place of business. If you have multiple locations within the state, say you have a factory in Bangalore, you have a godown in Mysore, you have two places, two addresses in your registration certificate. But principal place can be only one. So the requirement is that the records or the accounts needs to be maintained at the principal place of business. It is possible that in most of the, mainly in service sectors, the bookkeeping exercise would have been outsourced to some consultant. There will be no record at the place of principal place of business which is declared in the registration certificate, wherein there is going to be a penalty demand from the department unless there are backups which are maintained, because the records can be in form of electronic form also. But even in electronic form, no records have been maintained. Say you are taking the credit based on the invoices, but you are not maintaining the invoices in your principal place of business. Then department can easily say that you have to pay a penalty, and penalty can go as high as 50,000 rupees, which is based on the discretion of the departmental officer. Now, what's the records? Production or manufacture of goods, inward and outward supply of goods, stock of goods, ITC details, output tax payable and paid. All these details will be there for sure when you are filing your returns. There are many other particulars which have been prescribed in Rule 56. So there are at least 25 to 30 records which are there, which are prescribed in Rule 56. But we will understand and discuss only those which are very common for most of the taxpayer. Accounts of goods or services which are imported, exported, it will be there. Supplies liable for RCM. So with respect to reverse charge compliance, we need to maintain certain records. One is we'll have invoices from the vendors. Then there is a requirement to generate self invoice. Then there is a payment voucher which is required to be generated. Payment voucher has to be there for all RCM expenses. Self invoice has to be there for all unregistered vendor procurement wherein GST needs to be paid under reverse charge. Now there is new rule 47A, which is introduced from on which GST has to be paid under reverse charge. Then the self invoice has to be generated within a period of 30 days from the receipt of goods or services. So before this, we did not have any time limit which was prescribed. Now going forward, we need to comply with this requirement. Once you receive goods or services, then within 30 days, you should generate a self invoice. Remember, raising self invoice is different from the concept of time of supply. So time of supply may be different. Say you generate the self invoice in next month, but time of supply may be in next to next month. So you have to pay GST only in next to next month. Receipt voucher needs to be there. Refund voucher has to be there. This is for advance receipts. Name and complete address of the suppliers and customers. Sometimes we may not have a complete name and address of the customer. Say you own a movie theater. When you issue a ticket, I don't think you will have address on the tickets. So what will happen? Because Rule 56 says that you have to have address of the customers also. Luckily, when we see the invoicing provisions, it says that the address has to be there on the invoice only when the invoice value is crossing 50,000 rupees. So I don't think at present we are going for a movie wherein it is costing more than 50,000. So till that happens, we don't have to have address on this movie tickets. Then entries in registers accounts not to be erased, effaced or overwritten. Now this may happen only when we have manual records, since most of us will be having electronic records. This issue may not come because even if we overwrite or erase or delete any entry, so nobody may be able to find it. Service provider to maintain details of the goods used in services. Now, who is required to maintain this? It is not very clear. Say, we are a chartered accountant firm, we use a lot of stationery items. Should we have to have details of the goods which are used? Should we have to have details of, say, all the furniture, chairs which are being used? Should we have a separate records for this? This is not something which is very clear. Looks like where the goods are very predominant, say your authorized service station wherein you are replacing a lot of goods. So in those cases, there has to be a separate stock register. Otherwise, this may not be required. If you are maintaining the records in electronic form, then again there is a separate requirements. It says most of us use the applications like Tally. Unless we choose that option of maintaining the log, we may not be able to capture the log of entries edited or deleted. So in this case also, the department say that since you have not activated this option in your ERP, you have to pay general penalty of 50,000. This is possible. Then there are other requirements. Now, what will happen when any of these records or most of these records are not maintained? So as I said, there can be a general penalty which can go up to 50,000 rupees. So general penalty can be levied as per section 125. If you see, it says 25,000 rupees. This 25,000 rupees in CGST law and another 25,000 in SGST law. So total can be up to 50,000. Breaches of tax regulation or procedural requirements, and in particular any omission or mistake in documentation which is easily rectifiable and made without fraudulent intent or gross negligence. Now, what is minor breach? You may have a turnover of 1000 crores. You may have a turnover of only 10 crores. In both the scenarios, the minor breach is when the tax involved is 5,000 rupees. If the tax involved is more than 5,000 rupees, then the department will not consider it to be a minor breach. It is a major breach wherein penalty can go up to 50,000 rupees. Any omission or documentation which is easily rectifiable if the same is apparent on the face of the record. The example is, we understood in the previous slide that in case of RCM, you should have say in case of advances, you have to issue a receipt voucher. When you are refunding this advance amount for some reason, you have to issue a refund voucher. These refund voucher or receipt voucher, the contents have been provided in GST law itself. So we should be having these records as per GST law. When you are not doing this, the penalty can be up to 50,000. And remember, this 50,000 can be for each mistake. Say refund voucher you are not raised, 50,000 penalty. Payment voucher you are not raised, 50,000 penalty. Self invoice not raised, 50,000 penalty. The total can be up to 1,50,000. Now it is not clear whether this 50,000 can be for each transaction, or should it be for each month, or should it be for each year. Say the audit is being taken for 3 years. So can the department say that you have to pay this 1.5 lakhs into 3 years because you have not done it for 3 years? Or can they say that you are supposed to do this for 100 transactions, you have not done it, and it has to be 1,50,000 into 100 times. So can the department go to that extent? This High Court, Suvarna Fibrotech, it says that the High Court is saying that it can be for each mistake. So as per our example, it can be on 100 transaction also, but we don't know whether department will do this. But normally the High Court may give that benefit of compounding and paying only 1,50,000 or only 50. We don't know how it is going to happen. So one needs to be very careful. So if you have not done some documentation, we can take the benefit of section 126, wherein say a department because we would have paid the taxes. Only issue is procedural, wherein documentation is not issued, which is easily rectifiable as per section 126. So this benefit is possible, but we don't know how these interpretations are going to happen. Therefore, avoid any of such mistakes and always comply with the law. So if you are doing this 9C assignment, also see that this basic documentation is also taken care so that the client doesn't suffer in future. Now we'll understand the format of GSTR 9C. There are 5 parts into it. First part is gross turnover, which includes exempt supplies, exports, or any transaction which are not subject to tax. Then there will be a reconciliation of net turnover or the taxable turnover. After this, there is going to be a reconciliation of taxes paid, wherein we are going to compare this taxes paid as per GSTR 9 with actual taxes paid. If there are any differences, then we need to correct it. Then there is going to be a reconciliation of input tax credit. Then the last table 5, if there are any additional liabilities for any reason, say there is some litigation in order you want to accept that issue or the demand from the department and you want to discharge that, you have discharged it, we can disclose that. Say there is some wrong refund which you have claimed and you want to pay that. So these types of information can come into your table 5 to pay the taxes. So basic steps before we get into GSTR 9C, always start with the reconciliation. We know what are the reconciliations which are required. So reconciliation has to be there between your books of accounts, GSTR 3B and GSTR 1. There are going to be differences for sure. If such differences are resulting in additional tax payment, pay the taxes. If it is realized that there is a excess tax payment, then we need to see whether the tax refund is possible. Sometimes we would have collected extra tax from the customer and we would have paid. Then in such case, you will not get the refund unless you are paying back the tax amount to your customer. So we need to see whether practically it is feasible to go for refund or just leave it, because when you have paid excess, the department is not worried. Only when you have paid lesser tax liability, then department is worried. Then it is also possible that there are differences in ITC. So you have claimed lesser credit, no worries, department will not worry about it. If you are doing this exercise before time limit for taking the credit, then you have that advantage. You can take the credit in the return which you are going to file for October before you file your GSTR 9. If you have claimed anything extra, then you need to pay it back. So how will you pay it back? Any additional liability or additional credits or wrong credits you have claimed? There are 3 ways in which you can pay it. One, you pay it through DRC 3 form without linking it to annual return. Or the other way is you disclose all these details in annual return and take DRC3 form, link it to annual return and discharge it. The other way is you can pay it through GSTR 9C also. So these are the three ways in which you can discharge if you have any additional liabilities. So why reconciliation? It is very simple. So in order to ensure that we have a complete or accuracy or correctness of the information which is being filled in GSTR 9 or 9C, we need reconciliations. There are two sections under which the penalties can be levied. We have section 73. When there is no intention of evading any taxes, then section 73 is applicable, wherein the penalty can go maybe up to 15%. Whereas the notice is issued under section 74, wherein you have the intention to evade taxes, then the penalty can go up to 100% of the tax. When you have given any wrong information, misrepresentation, suppression of any facts or information. So these are the cases wherein department can always issue notice under section 74. Higher limitation period, higher penalties. So therefore, if you have made any mistake in disclosure in your monthly returns, so correct it by doing the reconciliation in GSTR 9. If you have failed to do so in GSTR 9, then you have one more opportunity to do it in GSTR 9C. So this is the importance of filing correct GSTR 9 and GSTR 9C. Plus, when you have this good system of reconciliation, then it also increases the confidence of the department when they come for audits. As per the departmental audit manual, when you have a good system in place, good internal controls, then they can reduce the number of days which they are going to spend for the purpose of audit, or they can reduce the sample size, which gives you a lot of advantage. What are the important reconciliation? There are plenty of reconciliation which needs to be done. So some of them have been discussed here. Some which are not very commonly done may be e-way bill summary versus your GSTR1. So there can be differences between these two. You are sent goods for job work. It is not a supply. Therefore, you have e-way bill, but you don't have any entry in GSTR1. It is fine. There can be cases wherein you have generated e-way bill, but you have not cancelled it, though you did not move the goods. After 24 hours, you can't cancel e-way bill. So same is applicable even for your e-invoice. In these cases, there can be differences. So when department will say, give the reasons for this difference of 5 crores. So instead of struggling at that time, anyway, we are doing so many reconciliations. See if these reconciliations also can be considered. Then reconciliation between your GSTR 2B or books of accounts. So it is also something which is very important in order to find if any credits are missed out or if any credits have been wrongly taken. Now we'll see clause by clause analysis of GSTR 9C form. Part A is quite simple. We have GSTN financial year, legal name, trade name. So legal name can be, one example is what? ANI Technologies. Trade name can be Ola. Name of the act if you are liable to audit under any act. This GSTR 9C form reconciliation has to be based on the audited financial statements. Therefore, the audit is required under some law. it can be Companies Act, or it can be income tax. So whatever is happening, you have to mention the name of those law in this particular table. Table 5. So this is the table wherein the reconciliation of gross turnover is done by taking the turnover as per audited financial statement. So when you have multiple branches, you need to arrive at the turnover of each branch based on the internal records which you have, which may be trial balance of each GSTN. So that should be the basis for you to including export as per the audited financial statement. So before you have this audited financial statement, you can't file your GSTR 9C because basis is audited financial statement. We know that there can be differences between the turnover which is declared in financial statements and GST return for various reasons. So financial statements will have a lot of entries which are not subject to GST. Example can be interest on fixed deposit. Another example can be dividends. You don't pay GST on interest on fixed deposit. You don't pay GST on dividend income. Similarly, you may have unbilled revenue. You have unbilled revenue, which you will consider it to be an income in your financial statement, but you don't consider that to be a turnover in your GST return. Therefore, there can be difference between these two. So like this, there are multiple reasons for which there can be differences. The format identifies certain reasons for which there can be differences. If there are any unlisted reasons, then the unlisted reasons can be there, and so the amount, corresponding amount can be provided in column 5O or the row number 5O, adjustment in turnover due to the reasons not listed above. This table was optional till 2021-22. From 2022-23, this has been mandatory. We have been suggesting our clients to fill this even when it was optional. There are certain things which are still optional, but what we suggest is, though the things are optional, if it is convenient for us, then let us give that information. Of course, there are certain exceptions. For example, I saw some questions on GSTR 9, whether the HSN summary should be given for inward purchases. So in that case, as a taxpayer or as an expert, I don't see any advantage of disclosure for the taxpayer as such, though there may be some advantage because they will get some statistical information. I don't see any advantage for it for the taxpayer. But there are few things wherein, though optional, it is suggested to disclose that because we see some advantage for the taxpayer. The example is 5B. 5B, unbilled revenue at the beginning of the financial year. So this one row is still optional. All other rows are mandatory, but still we suggest that you fill 5B also, because even if you show it as an unreconciled item or you show it in your 5O, department can always have this right to ask for reason of such difference, because they will have a doubt on whether GST is payable. If payable, whether you have paid GST or not. So for that reason, they can always ask for breakup of this information. Therefore, instead of waiting for department to identify this and issue a notice, let us disclose this information, because this will help me in future. I don't have to do any additional reconciliation. Now we'll see what are all the adjustments. There are certain things wherein we need to add. There are certain things which we need to reduce. If you see row number 5P, you can see what needs to be added, what needs to be reduced. So A, B, C, D, E, F. So up to F you need to add. All other things you need to reduce. So unbilled revenue at the beginning of the financial year. So you are going to add this, because unbilled revenue at the beginning of the financial year is nothing but the closing balance of unbilled revenue in the financial statement last year. When you have a closing, say 22-23, you had some unbilled revenue. 23-24, you have invoiced. So again, you will not take that into your financial statement, but you will take that in your GST return. So in that case, you need to add this amount because you are going to match this turnover with your annual return. It needs to match. So similarly, there are unadjusted advances on which you have paid GST, but you have not issued the invoice. So you need to add it because you have considered that to be a GST turnover. Then deemed supply under Schedule 1, this is nothing but say stock transfer or cross charges, wherein it is not there in your financial statement, but GST is paid and it is there in your GST records. 5A is very uncommon, credit note issued after end of the financial year but reflected in annual return. Then 5F, if you have any trade discounts accounted in audited financial statements but are not permissible, then you need to add it. Then 5G is not applicable, it is only applicable for first year of GSTR 99C. Then unbilled revenue as at the end of the financial year, you are going to reduce this because you will not pay GST on this. If you don't reduce that, then financial turnover shows excess, GST return is lesser, then it shows as if there is a unreconciled balance on which GST needs to be paid. Then if there are any credit notes which are not permissible under GST, so even that we need to add it because in financial statement we would have reduced it. Then 5M, adjustment in turnover under section 15. Section 15 is about valuation. For valuation reasons, there can be difference in the turnover which is there in financial statement and the GST return. Say construction activity. So construction activity, your turnover as per books is 100, but you are paying GST only on 66% or 66.66% after taking 1/3 of the value as deduction in GST law. There is a difference. So this difference needs to be adjusted in table number 5N. So similarly, there are multiple reasons wherein the valuation difference can be there. Another example can be gaming companies. Gaming companies, GST is paid on entire deposit value, whereas the turnover is in the financial statement only the commission value. Then there can be adjustment in your foreign exchange fluctuation as well. For the reason, one can be the fluctuation in the exchange rate itself, or it can be for the reason of GST. So when there is an export of goods, we need to consider the exchange rate as notified by the customs. If you are taken as per the books of the RBI, then there can be chances of difference. So in such case, the adjustment needs to be made in 5N. 5O is the favorite row. If you have difference for any other reason, for example, if you see the interest on FD, nowhere it gets adjusted from 5B to 5N. So it needs to be adjusted in table 5O. Similarly, dividend. So similarly, uh, say duty drawback, you have a sale of scripts which are not subject to GST, which is not there in your GST return. So these things needs to be considered here. 5O, you are going to reduce that because it is there in financial, but it is not there in your GST return. So these adjustment needs to be made in 5O. If you see 5O, only amount needs to be given. It doesn't ask for the reasons for which there is a difference. But what we have been suggesting the clients is that in table 6, you say you give the breakup for 5O also. Advantage is, again, department need not issue a letter or notice to us asking what is this different towards. That is the biggest advantage. So whatever we discussed till now, along with examples I have given in this PPT, so one can refer to this PPT and the examples to understand what needs Just give me a moment. So all these slides wherein I have already discussed the table, I am skipping it because with example it is there. This PPT will be shared with you as well, wherein you can understand what needs to be filled where. As I said, in this table, only 5B is optional. All other rows are mandatory, but still I suggest that you fill 5B also so that it is complete in all the aspects. Before table 7, there is a table 6 wherein the reasons for difference between your table 5 turnover, which is adjusted turnover, and the annual return turnover has to be given. If you are getting a difference, the reasons can be because of rounding off, or it can be because of lesser tax payment or excess tax payment. If it is any other reason, say such as duty drawback, interest, any other non-operational income which is not subject to GST, then it has to be adjusted in 5O. Then whatever amount which you are mentioning in 5O, my suggestion is you give the breakup in this table number 6, wherein you can write also. You can say 5O include 5O consists of 1 crore rupees, wherein 50 lakhs is towards bank interest, 20 lakhs is towards scrip sale, some other reasons, which can be any other reasons. Say, for example, you have sent the goods for job work. You have paid GST because you did not get that in 1 year time limit. So in that case, you will pay GST, you will have turnover in GSTR 9, but you will not have any amount in your financial statement. So you can say that it includes, say, 30 lakhs towards this instances wherein GST is paid, but it is not considered as turnover in the financial statement. After all this adjustment, you will come to table number 7. Remember what you are taking as the basis in table 7A is the adjusted turnover, which includes exempt turnover as well as export turnover and taxable turnover. So we need to arrive at the taxable turnover. Therefore, all other turnover, you are going to reduce it. So 7B, value of exempt turnover, nil rate, non-GST turnover, no supply turnover, you are going to reduce. If you have any export transactions, which could be zero rated, say exports or SEZ supplies, you are going to reduce that. If there are any supplies which are subject to tax and a reverse charge by our customer, remember we are not talking about expenses to be filled in 7D. We are talking about our income wherein customer has to pay GST under reverse charge. Say you are not a body corporate, you are giving a security agency service to a body corporate. In that case, the security agency will not fill this, the security agency will fill this information, saying that this is my turnover, but my customer will pay GST on this. So after all these adjustments, you will get a net amount which is taxable amount as per 7E. This needs to be matched with your annual return. If there is any difference, then the reasons for such differences needs to be identified. The reason for difference, again, it can be for the same reason which I mentioned before. It can be because there is a excess turnover or lesser turnover which has been declared. So when you are seeing that there are exempt turnover, concession rate, in all these cases, you need to make sure that you check the corresponding notification, clarification, documentation with respect to exports as well. It should not be limited to just filling in the blanks. Table number 9. So table number 8 is also there. Again, 8 is only to specify the reasons when you have a difference between the turnover as per books of accounts and turnover as per the GST returns. Table number 9. So till now you saw that what we have discussed is only the turnover or my income part. Whereas I am paying GST even on my expenses to a certain extent. So where will I show that? So these details should be shown in table number 9. If you see for all the different rates, there is a separate row for reverse charge. RC is nothing but reverse charge. So for 5%, there is a reverse charge, 12% reverse charge, 18% reverse charge, 28% reverse charge. If there are any interest and liabilities, even those details will come here. These amounts will get matched with the amounts which are being declared in annual return as well. Make sure that the total of this outward liability is matching with your table number 7. So table number 7E, you have a turnover. The breakup between say 5%, 12%, 18%, it should match with the total of IC. If it is not matching, then it indicates that there is some issue with the information which is filled either in GSTR 9 or GSTR 9C. Then table number 11, you don't have to fill this because if there are any additional liabilities, we can just show that in table number 9 itself. The differential amount can be paid by giving a comment. The other option is pay additional liability through GSTR 9 so that you can give a correct picture in your GSTR 9C table number 9 itself. So table number 12. So this is the table wherein the GSTR, the ITC is going to be reconciled. 12A, ITC as per financial statement is required to. So for this table, you should consider only 90 lakhs. It is not 1 crore. If there are any credits which are booked in financial statements of previous year, but you are taking in the annual return now, so that can get added to 12B. Similarly, you may have certain credits in this year, but because you have not fulfilled some condition, it can go to next year. So by March month, you would have taken the credit. So thus, those credits should get reduced in 12C. If there are any differences, again, differences can be for two reasons. One is you have claimed excess credit or you have claimed shorter credit. If it is excess claim, then you may have to pay GST. If it is lesser claim, then unless you are identifying this before filing your annual return or return for October month, you will have time. Table 14, this is what I was mentioning. So these are the tables. This is one of the table which is optional as of now. When it is made mandatory, then it is going to be a very, very tough exercise. So in this table, they want you to identify all the purchases, then corresponding ITC on purchases, freight and carriage is separate, imported goods is separate, then royalty is separate, employee cost is different. So like this, there are multiple breakups according to which we need to identify the amounts with the credit amount. So this was discussed in one of the meetings, and it was said that this is going to be optional as of now. So you don't have to fill it now. If they make it mandatory, then it is going to be a Herculean task. You can just fill table number 14R, wherein you are going to fill the total credit amount, which is as per 12A. Then you will match this with your annual return turnover. If there is any difference, you are going to rectify this. If it is payable, you have to pay the differential amount. Then table number 16. So this is the table wherein you are going to give the differences for ITC claim. If there are any differences, so you will give the amount. Say certain amount is payable towards CGST or certain amount is payable towards IGST. You are going to mention that amount for payment of taxes. Part 5. So part 5 also, I don't suggest you to fill this information. This was more relevant when the certification by auditor was required. Now it can be relevant only for certain cases. Say if you can see that wherein we can show the erroneous refunds claimed for payment. So this is the table wherein you can fill that and take it. If it is any other amount, say there is some outward liability at the rate of 5%, so this you can disclose in other tables which we discussed, or you can disclose it in table number the form number 9 itself, so that we don't come to this table to fill and pay the taxes. Interesting part here is it still says that to be paid through cash. If you see the row above this tax columns, you have description, you have value, you have central tax, state tax, IGST, cess. Above that, it says that it is to be paid through cash. Now the question is, should I pay it in cash when I have sufficient credit balance? I have a credit balance of 1 crore rupees, whereas the amount I need to reverse is only 10 lakh rupees. Why I should pay it when I have a sufficient credit balance? Now we can say that 9C is also self-assessed tax. The credit which is there in our electronic credit ledger can be used for payment of CGST, SGST or IGST. So based on same logic, we can always say that the taxpayer still has the right to pay any additional liability through DRC3 utilizing the credit. He need not wait for or he doesn't have to pay it only through cash. This is what I was mentioning. So verification by registered person, I hereby solemnly affirm and declare that the information given is true and correct and nothing has been concealed. So when the taxpayer is saying that it is true and correct, nothing is concealed, then if there are any issues identified, then the department can always say that, see, you have said that you have given the correct information, but information given by this happen. Some of the other important points to be considered. I was mentioning that whenever you are taking up 9C assignment, you make sure that you convert it into compliance review and 9C rather than restricting it only to fill the form GSTR 9C. Because if there are any exemptions, if there are any concession rate, we need to make sure that the related conditions are also fulfilled. If there are any transactions with the related party, distinct person, we need to see if there are any tax impact. Nature of supplies, whether the tax rate, whether it is being considered properly in case of mixed supply, composite supply, non-composite supply or not. Advance receipts and implications. Then export condition, you have classification. Sale of fixed asset is something which is very common wherein GST will get missed. Say you have a sale of old motor vehicle. So in such case, the GST has to be paid on the margin value. Book value is 100. You have sold it for 110. Then on 10, GST needs to be paid. And the rate is also lower. It will not go beyond 18%. So these are the benefits which we need to take. Similarly, even in case of exports, we need to see if there are any exemptions or concession claimed by the vendors. If yes, is there any obligation for the recipient to fulfill? If it is not fulfilled, then suggest to fulfill that. Then all others are self-explanatory. I'm not going to discuss this. Then there are certain common issues like IST versus cross-charge. IST and cross-charge at present it is optional. You can do any of this. But come April 2025, you have to follow IST for distribution of credits in case of third-party supplier invoice. Cross-charge can be only for internal support. Then few other common issues which are there. Wrong type of GST paid. I am supposed to pay IGST, but I have paid CGST, SGST. Then benefit of section 77 can be claimed. What will happen if in case of RCM I have done this mistake? I have taken interstate supply, I should have paid IGST be done in that case. So in that case, I may not get benefit of section 77 because section 77 says wrongly taxes collected. In that case, the adjustment can be made. When this is the case of tax payments by us under reverse charge, then the benefit of 77 may be denied. Therefore, one needs to be very, very careful when paying the taxes. If you already done a mistake, then one contention which you can make is whether it is CGST, SGST or IGST, the entire benefit, say the recipient is eligible for full credit, then we can say that there is no revenue loss. Wrong type of ITC. I am supposed to take IGST as the credit, but I have taken CGST, SGST or otherwise. Then in such case, we can use certain High Court decisions. So there are totally 3 High Court decisions of Kerala. One is this Divya SR case. Then we have a Chupkat Krishnan Praveen case. And last week also there was one decision of the Kerala High Court. And there is one Madras High Court decision wherein the courts have sent back the matters for reconsideration because there is no revenue loss and overall the credit taken is matching. Say there is 100 rupees IGST to be taken, but I have done 50 rupees IGST, 50 rupees SGST. In that case, total amount is matching and there is no revenue loss. For that reason, any additional liability should not be demanded. So this was the ruling in most of these cases. So GST on exports or the goods not exported, sometimes you may into a automobile parts manufacturing activity wherein you are manufacturing the molds, dies, jigs, etc. But you are not physically moving those goods outside India. Say molds or dies are manufactured, but the manufacturer is in Singapore. And these molds or dies are not moving, then in such a case, GST has to be paid, which will become a cost. Then rule 42 on exempt supplies. There are high C sales. If it is a high C sale, we don't have to do any reversal. Sale of duty scrip, no reversal is required. Then interest income, you don't have to pay GST or the reversal of credit is not required. If there is a sale of security, then 1% of such sale amount has to be considered to be a exempt supply. Say you have mutual funds. If you are going for redemption, then you need to see that 1% of the value of security is considered for Rule 42 credit reversal purpose. This is applicable even in case of mutual fund redemption. So these are some of the important points which I had to discuss. As said, so if you have any other doubts relating to 9C, please feel free to write to me on mahadev@hnaindia.com. We will answer maybe in a day's or 2 days time. This PPT also will be shared because this PPT has a lot of examples to understand all these rows as well. So if there are any questions with respect to GST and 9C, then I'm happy to take it up. We have 10 minutes time. Yeah. From Shivakumar, we have a question. We have an SEZ unit which are about to close, and we have GST registration. And if your total turnover, that is aggregate turnover on PAN basis, is crossing 5 crores, then you have to file GSTR 9C. In this example, say STPI is having 6 crores turnover, SEZ unit is 0, and it is under same PAN, you have to file nil returns for SEZ unit in order to avoid your general penalty. We are having two GSTNs, two separate states with same PAN. Should we file separate line for two GSTN? As I said, we need to see the aggregate turnover. If your aggregate turnover is crossing 2 crores or the limit of 5 crores for 9C purpose, for all the registered places, you need to file your GSTR 9 or GSTR 9C as the case may be. Then again, Shivakumar is asking where we need to show interstate stock transfer in 9C. So I had told you, so there is a specific table in table number 5 itself. We have a deemed supply. I think that row is 5D. So if you see 5D, it says deemed supply under schedule 1. Schedule 1 covers any transactions wherein you don't have any consideration, but you have to pay GST on that. Example is stock transfer, or you have some supplies to, say you are a manufacturer of clocks, wall clocks. You will give one clock to your employees. So in that case, you have to pay GST though your employee doesn't pay for that clock. So this transaction on which GST is being paid has to come in this table number 5D. Misha Solanki is asking, kindly elaborate table 12 in detail. Also cover impact of 8C of GSTR 9. As Akshay would have discussed, there can be a difference between 8C of GSTR 9 and 13 of GSTR 9s. There can be differences. So this table number 12, you need to match with table number 13 of GSTR 9. And table number 12 of GSTR 9C, you should start the reconciliation with net GST credit. You have availed, say, 100 rupees as the credit in your books, but you have also reversed 10 rupees for whatever reasons in the books. You should not take 100 as the basis for this. You should take 90 as the basis for reconciliation. If there are any past credits, you need to add it, which you have taken this year. If there are any credits which are there in books, but you are not taken in your GSTR 9C, you need to reduce that amount. So net of all the reversal, you need to show in table number 12. You can see the examples also in the PPT to get more information on that. You can also see the instruction. When you go to the portal, you will get the form. You will also get the instruction. Many a times we miss the instruction which is there in the Excel utility file. When you refer that Excel utility file, you will get answer for most of your questions. GN and Co. We have reported input to be availed in audited financial statement for 23-24, but we are not subsequently availed said inputs during April 24 to November 24. We are going to expense of in the books of accounts. What will be the consequence in 9C? So in this case, you can start with the actual with before reversal whatever amount you have. Say 100 rupees is the amount which you have availed in books of accounts. You are supposed to take only 90. This 10 rupees you have not reversed by November month. You are going to do that in say December 24. Then you can give a comment in table number 12 saying that say in 9 also you have taken only 90. So you will start the reconciliation with the basis of 100 in financial statements, 90 in your GSTR 9, balance is 10 unreconciled amount. You will say 10 is the ineligible amount which is reversed in books of accounts of 24-25. You can say this. CA Mihir, if the taxpayer is builder, developer to whom no ITC is eligible, still HSN is required to be provided. As you would have understood, inward HSN is not mandatory now. If you're not taken credit, then you may not have to fill this information also. So once they make it mandatory, then we may get more clarity on that. Can you please provide more info on reclaim reversal reporting in 9? The PPT will be shared wherein he has given the example also to understand this. Whether 12B is mandatory, I guess it is mandatory. I may have missed it also. See, as I told you, even if it is not mandatory, please fill this because we have advantage in filling table number 12B. We also discussed table number 14, which is not which is optional as of now. But there my suggestion is you don't have to fill table 14 because we don't have any advantage by filling that wherein we need to give breakup of different heads of expenses. What is the credit on royalty? What is the credit on employee expenses? There is no advantage for that. Advantage only for department. Whereas 12B, when we fill this, even if the department asks the breakup for that in future, we can always say that this is the breakup for that. Unadjusted advances at the end of the financial year as per the balance sheet may have all the years. So in 9C of 23-24 to be considered or all the years put together. See, you need to see, you have to understand why we are doing RICO of financial statements and GST return. So there are reasons for the difference between these two. One can be unadjusted advances at the end of the financial year as per the balance sheet. Now, unadjusted advances are those advances on which you are not issued the invoice, you are not recognized that as the income in your financial statement. It is there in GSTR 9, it is not there in financial statement. Therefore, you are adding that to financial turnover so that it matches with your GST turnover. This is the logic you need to understand to get answer for this. So previous years also, if you have any unadjusted advances still continuing, you would have already adjusted that in your previous financial statement. Therefore, you should not consider that again. If commission is paid to party outside India, then whether RCM is applicable. See, if it is a intermediary service, then we need to see for any RCM for that matter, any expenses wherein you are making payment in foreign currency, you need to first ascertain whether you are the service recipient. If you are the service recipient, then you need to identify what is the place of supply. If the place of supply is in India, then you need to pay GST under reverse charge. If the place of supply is outside India, then you don't have to pay GST under reverse charge. Commission, I am understanding that this is a intermediary service, that is agency service. Intermediary service or agency service, the place of supply is the supplier location. Assuming that in this case supplier is outside India, the place of supply is also outside India, then you don't have to pay GST. Prior to GST registration, where we need to disclose the turnover in GSTR 9 or 9C, you can adjust this in 5.0. 5.0 says in table number 9, you don't have to take this. Table number, in annual return, you will show only whatever is disclosed in your register after the registration. Say your total turnover is 110, 10 is before registration, 100 is after registration. Your annual return will say 100, your financial statement says 110. So this balance 10, you will show it in 5.0. You will give the reason saying that this 10 which is shown in 5.0 is turnover before registration. Yeah, I think I have answered all the questions. So we have 1 more minute. If there are any additional questions, then we can take it up. We can wait for 1 more minute. Sandeep is asking if RCM 12% paid instead of 18%, he declaring 18% in 9 and 9C, can he take input tax credit? Yeah, you can do this because there are, see, in GST, we don't have any precedent or no case laws which are available to understand how the courts are going to take this up, how the department is going to take it up. This concept was there even prior to GST also, because in service tax law also we had this case wherein there could be expenses wherein GST is not payable under reverse charge, but somebody has paid it under reverse charge. Department used to deny the credit, saying that you have wrongly paid it, therefore you should go for refund and you should not take the credit. And this they used to tell after the time limit for taking the refund. So time limit for refund in service tax was 1 year. So they will do the audit after 2 or 3 years. So they will ask the assessee to go for refund, reverse the credit. You cannot go for refund also because time limit is over. The courts in these cases, in most of the cases, they have held that whatever tax you have paid under reverse charge, you will get it as a credit. Therefore, taking the same analogy in GST also, it should be allowed, though department may question. We will say we have paid 18% and whatever is paid under reverse charge, unless such expense is restricted for credit, I will take the entire amount as credit. So I may show it as 18% as the liability instead of showing it as a 12% liability and take full amount as the credit. Yeah, looks like there are no more questions.